Do you know what the real enemy of building wealth is here in America? It's not inflation, it's not stock market volatility, it's taxes. Did you know that you could get taxed on the same dollar 2, 3, 4, or more times throughout the course of your entire life? Today, we're going to dive into this topic on taxes, and if you stick with me until the end, you will learn how to get yourself into potentially the 0% tax bracket in the future. My name is Amanda Ryba. I have been a licensed financial coach and consultant for the past 8 years as of the date this video was produced. And it is my goal to illuminate to the world what wealthy people know and understand about money. And one thing all wealthy people understand is how to leverage the US tax codes in their favor. Now, before we dive right in, I'm going to give you some context to this story by explaining some key important dates in American history around taxes. The idea of paying an income tax wasn't even a thought until the government didn't have enough money to fund the Civil War. So in 1861, the federal income tax was introduced to the American public. Then in 1862, the very following year, the IRS, the Internal Revenue Service, was created to collect taxes and administer the US tax code. Then that tax eventually went away because it was just deemed to be unconstitutional. But then in 1913, the 16th Amendment was ratified, giving Congress the authority to instill a federal income tax. Since then, taxes have played a significant role in the lives of many Americans. When you earn money, you first encounter an income tax. This can be federal, state, and sometimes local, but taxes don't stop there. If you decide to spend this money, you're going to incur a sales tax on most goods and services. And if you decide to save and invest and you earn interest, dividends, or capital gains, that money is also taxable. But even in death, taxes follow. Estate taxes can apply to the money and assets you accrued throughout your life, meaning your dollars could get taxed again before reaching your heirs. Currently, estate tax is only applied on estates valued at over $12.92 million. However, come January of 2026, that level is expected to get reduced back down to the year of 2017's levels, somewhere around $7 million per person. With so many layers of taxation in America, it's crucial to consider strategies that allow your money to grow and compound tax-free. One of these strategies includes saving money into accounts that are considered tax advantage. Accounts such as Roth IRAs, HSAs or health savings accounts, as well as 529 college savings plans, all grow your money all tax-free. Roth IRAs are considered qualified retirement accounts where you contribute with after-tax dollars and that money will grow tax-free and be tax-free upon withdrawal in retirement. However, if you make more than $161,000 gross earned income if you're single or $240,000 in gross earned income if you're married, you make too much money to qualify to open up a Roth IRA. And you're very limited with what you can contribute. Currently, as of today, 2024, if you are age 50 or under, you can only contribute up to $7,000 a year. If you're 50 or older, you can contribute up to $8,000 a year. And you must have earned income coming in order to contribute. Also, if you want to get to that money prior to retirement, you run the risk of paying taxes and penalties. You have the ability to touch your cost basis, which is the money that you contributed into the account, after 5 years. However, you cannot touch your interest until after age 59 and a half. If you do, you will pay big taxes and penalties. HSAs, healthcare savings accounts, have a triple tax advantage. The contributions going in are tax deductible, the money grows tax-free, and you can access it tax-free if it's used for a qualified healthcare expense. 529 plans are an option for educational savings. You contribute with after-tax dollars and the money does grow and compound tax-free and can be taken out tax-free if used for a qualified educational expense. If not, and you take money out, that money will be taxed and penalized. Now, I don't know about you, but all I hear is rules, rules, rules. There has to be a better way to do it. And in my opinion, there is. I have spent the last 8 years of my career mastering how to help people build wealth inside one of the most lucrative tax shelters available to Americans today. Yet most people don't understand or know anything about it, and that's life insurance. There are 3 main tax codes that are buried inside of life insurance that allow assets to grow tax-free. Through IRC code section 72E, 101A, and 7702, you are able to grow your money, access your money, and pass on your money all tax-free. And here's how it works. It all starts with a permanent life insurance policy that you overfund the cost to own. Every bit of money that you contribute in excess of the cost grows tax-free inside your policy. You have the ability to access that tax-free at any point in your life for anything that you need. And if you were to pass away, that money would get added to the death benefit of the life insurance policy, blossom and transfer onto your family, all tax-free. Now, I personally love the fact that I can access my money out of my insurance policy at any age without any penalty, because you never know. An opportunity or an emergency could come up in the future and you may just need access to your money. Now, there are 4 different kinds of permanent life insurance policies that you can do this with. I personally prefer working with IUL policies, and the reason is because looking at past performance history, IULs tend to grow your cash value the fastest. Now, disclaimer, there are many different ways to design an IUL policy to grow cash value. If this is something that you're interested in for yourself, I recommend that you connect with a licensed life and health agent where you live that is trained and seasoned on developing these types of strategies for people to build wealth. Sit down with them and go over your numbers to see what might make sense for you. By taking advantage of a combination of these 4 tax advantage accounts, now you can start to move yourself into the 0% tax bracket. Hopefully this video expands your knowledge on taxes, why taxes were originally created, and how to pay less of them in the future. Now, I want to be very clear. I am not against people paying their taxes. What I am in favor of, though, is people understanding how to leverage the US tax codes in their favor to pay the least amount of taxes required. Now, disclaimer, I am not a CPA. This video is not meant to be taken as tax advice or investment advice. I recommend, if you're interested in any of these strategies, that you get with your tax professional and go over this and see what strategies might be best for you. If you're interested in implementing any of these strategies and you have questions and you'd like to chat with me or somebody on my team, you can click the link in my bio that will take you directly to my calendar to schedule a complimentary consultation with us. As always, I love it when you stay till the end. If you like this video and you want to see more videos just like it, click that subscribe button and hit the bell to turn on notifications, because I release a new video every single week and you don't want to miss it. Please share this video with anyone else that you can think of that cares a lot about understanding the tax brackets and the system and how to pay less. Thank you for sticking with us. And again, my name is Amanda Ryba, signing off as the founder of the Illuminate Your Wealth community. See you next week on YouTube.